Good afternoon, Steve.
Yes.
My name is Van Karnalantam. I'm the CEO of Fidus Mortgages. I'm here with Steve Lang from VWR Capital.
Yes. Thank you for having me. And just to introduce myself too. So I'm Steve Lang. So I'm the Director of Sales and Marketing at VWR Capital. And I'm out here from Langley, BC, where our head office is located.
Perfect. It's quite some podcasts coming all the way, guests from all the way down from Vancouver and bringing some warm weather.
Yes, absolutely.
Steve, we've been working for a very long time and we have an amazing relationship. So for a lot of clients, they don't know what VWR is. Can you give us a little breakdown of what the VWR is about?
Sure. And I would love to give a little breakdown, but I'll probably go on a bit of a rant because
Please.
we've been around for quite a while. So we were actually founded back in 93. So one of the first private lenders, registered as Mortgage Investment Corporation by Dougal Schuin. So he was our original founder. And since then, we've been a trusted partner. We have other MICs actually invested in us as well too, and we've expanded our reach from BC all the way through to Ontario. So currently our portfolio, we're close to $800 million of mortgages under administration. And in reality, we have just a simple product, easy to understand, and we've kept it that way over the years and have established great relationships like we have with you.
Perfect. Steve, when it's come to private lending, a lot of clients get scared when they hear the name private lending. How your organization, VWI, is different from other organizations or other private lenders? Like you guys have a well reputed in the broker industry and the client perspective as well. How you guys are different from the other lenders?
Yeah, I think when everybody hears the name private lender, they think worst case scenario and
Loan shark.
they loan shark. They think, I don't know, just somebody with a bag of money that's lending out something and they might get it back or not. So it's hard. Perception is reality. So we do have to fight that a lot of times. And we are registered as a mortgage investment corporation as well. So we do operate with the three companies that flow through dividends to our investors. We do have our investment side as well. We have named that now Stillman Capital Management as well. And we do have a syndicated line of credit behind us as well too, where there is 5 major banks involved in backing our mortgages as well, or we can draw on that when we need to as a line of credit. And that shows you the rigor of audits and compliance and regulation that we have to go through as a company. So I don't think we're much different than any alternate lender out there as well. It's just we do fall under the private lending umbrella as it's currently defined.
Steve, you mentioned about the line of credit. So can you explain to the audience how the line of credit works and how is a competitive advantage for you as a lender and how that actually is a competitive advantage as a borrower as well?
Yeah. So really, we want to make sure, I guess.
So you can walk us through the flow of the funds, how that's end up in costing cheaper because you have a big portfolio.
Yeah. So I think maybe if we just start off the end goal of the company a lot of time, or the end goal for VWR is investor return, if you look at it.
Absolutely.
At the same time, we don't want to rip anybody off. We don't want to have high rates, but we are an equity-based lender. So that being said, we do draw money in from individual investors. We're currently just in BC. We're registered to take investments from individuals and corporations. They expect a return. We price our mortgages accordingly. There is times though that instead of getting the funds from investors, which is very high, you have to pay them high returns. You can borrow the money on a syndicated line of credit for actually cheaper than what you have to pay out to investors. So it is a balancing act. I'm not going to sit here in sales, marketing, and operations and pretend I'm an expert at all of that. However,
On a high level.
at a high level, for sure, it is cheaper a lot of times to borrow than it is to ask for more investments. So it's a balancing. We've actually paid down a lot of our line of credit right now. We do have more investments. And we do, like we do every year on RSP deadline day, we do have another deadline for taking investments in as well. So
Perfect. So when you have investor line, the higher the investment, you can syndicate more line of credit. That's true?
Yeah, correct. Yeah. I mean, keeping capital available is expensive. If you have a syndicated line of credit for $300 million sitting there, you're still paying annual fees, you're still paying monthly fees. And so you want to be utilizing it as well. Same if you have investor capital there, you have to pay them a return. If you didn't lend out $1 of that, you're still expected to pay a 6 to 9% return. And that is very, so it is a lot of times on us to always have mortgages coming in the door and lend that money out. So we are looking to give the money out all the time too for the right deal.
Right, borrower.
Yeah.
So that's being leads into the thing. Like, how are you, when you come to private lending, it's equity lending. How do you mitigate your risk?
Yeah, so mitigated risk, we actually have to focus on what we are good at, what we know, and what our investor appetite is too. So one of those things is our loan to value, for an example. In the offering memorandum, our maximum loan to value is 75%. So that is one of our firm rules. The rest are guidelines, I would say. So we don't go over 75%. And then we have our underwriting department, which also has a manager there with our policies and procedures, especially in BC right now and in Ontario. I guess the compliance, the regulations, policy procedures have to be all queued up, all written, all the way through the process. And really, we are very data driven these days too. I like to say we're data informed as opposed to data driven, actually. So it's not the overall NB, it says this, but we know something else. Data tells us a lot. If I'll be honest though, we're a boring lender. So we want your conventional, cookie cutter residential home in your urban area. So the bigger pocket of people that are available to buy that home, that's more likely to be what we approve at our highest loan to value. If we take away from that, let's say there is a nuclear power plant, for an example.
Yeah, we went through that.
There's sometimes that's a little more difficult, and we need to have the data there to back it up. And I mean, sure, we do take risk, but mitigating risk, it doesn't have to always be rate, right? So we do have very competitive rates and low fees in the market as well.
So when you look at the data, you merge urban, so it's more marketability if something.
Yes. Pride of ownership, marketability of the property. Yes.
And so we went through the correction in the market. And how are you mitigating your risk? And how are you seeing the market compared to 3, 4, 5 years back?
Yeah. So, I mean, there was definitely a peak in the market back in year 2021, 2022 area there. We are a 1-year term lender as well, right? So we do recycle our mortgages, I like to say, quite a bit. But more and more people are renewing, right? So what we've done in the meantime is on condos, for an example. This is one that's all over in the news. So in the GTA, there's, I think, now up to 8 months of inventory in condos. So we actually still lend on those condos, but only to 65% loan to value. So the likelihood of us, if we were to have to get out of that mortgage, and by that I mean take over the mortgage if somebody stopped paying, we're more likely to get our funds back. So there is certain times where we have to also judge, okay, are we at the bottom of the market, or is it going to completely tank? There's things like bare land, for an example, that we've just stepped out of right now because it's
not moving.
It's not moving. Getting a value on it is at the best of times is very hard because it sells a lot privately before it actually hits the market too, right?
So how do you mitigate this risk of when things doesn't go well or when there is not equity, because you're borrowing at 75%, some of the properties, if they're not renewing it, the value has been dropped almost 15, 20 points.
Yep.
So how do you mitigate those risks?
Yeah, with the current ones that we have, or just
on the previous ones?
Yeah, on the previous ones. I mean, I think during the time of lending, when you see you're at a price point that is beyond the average price of that area, we do and we have
cut down the slut
down at those times. So Hamilton is a great example. I saw a purchase come across my desk in the middle of town in a regular neighborhood for $1.2 million during the peak. And I was like, average price, not even close to that. I think we should pass on this deal.
And you did.
And we did. And I mean, honestly, just going around talking to different brokerages out there too, you hear things,
Yeah.
right? Brampton being another example. And it's kind of like, okay, maybe we should scale back. So we do see our concentration of our portfolio. Alberta's another example of that, where it was just straight up, even during COVID, after COVID, when GTA was going down, Alberta was going up, and it was going to hit a peak because we saw properties over $1 million all of a sudden. And it's like, okay,
There's a time to stop it.
we're going to do different things. So in Alberta, for an example, we raised the rate a little bit to discourage business, which actually helped us slow down the volume that we needed.
You have an amazing products. So can you talk about your first and second mortgages and maybe elaborate about the rates, fees? How do you guys differentiate from the other lenders?
Yeah, for sure. So thank you for saying that. And our product is super simple, fits on one page. We actually only have a 1-year term, open or closed, for our first and second mortgage. So you could put that in a category of 4 products maybe, but we keep our fee structure. If it's an open term, it's 1% for lender fee. If it is a closed term for 1 year, it starts at $750, right?
How are you being extremely competitive in the space with the low fees? It's pretty much the no fees.
Yeah, I would say a lot of people do promote us as no fees. There's a huge difference between provinces, though, when we talk about this. So in Ontario, the focus is what is this? What is it in Ontario? It's speed to get the deal done, and time costs money, right? We have the same fee structure as proven in BC, where a $750 fee is still questioned. Right. And it's not how long to get the deal done. It's what does it cost and time.
So you get a pushback on the $750. Here is in Ontario, it's a blessing.
Correct. It sounds silly, but that is true. And
It's the mindset of the client.
it's the mindset of the client. And I'm not saying there isn't differences in clients here and there too, but there is a big mindset. But we wanted to have something that we don't have to have different products in every province. We don't want
But you
to.
keep it simple.
It's simple. Everybody understands. Our branding reaches across the country.
Yeah.
We also, our original founder, and to this day, Dimitri, our CEO, and myself, we do not want to rip anybody off. We want to pay for the risk we're taking, for sure. And that is enough. The margin on our mortgages is what earns our investors the money. The fees, they're much smaller when it comes down to it. And adding an extra $1,000 here and there, would it help? Sure, but it doesn't help that client in that situation.
But that's a significant difference. Let's be honest. Like compared
Very
to
big.
your competition, that's a significant difference.
Yes, it is. It is very big, and I'll relate that to when I go through the product to renewals and
I was going to get into that. I'm glad you touched on it. So let's continue the conversation.
yeah. So I think that's a huge part of our product that we don't talk about enough, and we probably need to more. Is we do renew if everything's satisfactory, if your insurance is there, if your property taxes are paid, you've made your payments on time. We do offer a renewal. We are not going to send you a letter to say go find somewhere else. It is only $200 for another 1-year.
Significant. And even then, my question is how you guys are staying competitive and why you guys have a very flat fee of $200 compared to the competition.
Yeah, I mean, again, at renewal, there's exit strategies for sure that people have. There's a lot of times where it just doesn't work out, and then there's market. We know that it is very hard to get out of private lending to alternate to B to A, and things happen, and we're willing to still renew at market rate, and we continue on that pipeline of margin on your mortgage for investors. So it's still a good thing for us to keep that. It's actually one less mortgage we have to go out and get. So $200 for us,
If someone who's keeping up the payment,
it is a smart move to make.
sometimes known devil is better than unknown angel.
Yeah.
So you reward the clients who keep up the payment.
Correct. Yep. And we're not the first to say, okay, you've missed your 2 months of payments. We're never talking to you again. So we do have a department, mortgage recovery as well too, where we will talk it through. If there's something that they're behind on, maybe we'll work out a payment plan for 6 months to get those property taxes paid down. So we want to work with you to get you somewhere. We're not working with you just to get your money and say goodbye. Like we'd like to be a part of the financial advice in this journey.
Absolutely. You kept repeating, we are not here to rip the clients off. That's a huge word, especially in the private lending.
Yes.
Where does the value come to VWR from? I'm sure it must be coming from the visionary of the leadership.
Yeah, so I mean, definitely day one. I mean, I guess I can proudly say it was one of the reasons I came here too, is because I came from a credit union world where it's just relationship, relationship, relationship.
Relationship.
And that's
And you went from a private lender.
yeah, and then I go to a private lender. Everybody's like, what are you doing?" So then there's perception. It's like, well, we're actually probably helping this space move forward
Absolutely.
by professionalizing it, not being the person who charges 3% at renewal. We have the funds, the support, the experience. It's just ingrained in us of who we are.
And that speaks a lot about the values of the company, and that's also make the brokers like us to work with you guys, because it's not here to put the client. But I feel like Steve, when the clients are coming to private lending when they're back against the wall,
Yes.
it's not maliciously they have done something wrong. They're life-changing event, death, separation, losing job. That's where they're coming. They need to fix it. So we cannot beat the person that's already beaten in their life. And store so much respect for how you guys handle those situations, and especially the renewals. Not everyone want to continue.
I
But they have an option, and that's the first conversation I have. I'm like, yeah, you have a 1 year exit plan, but how do you know things are going to get fixed in 1 year? What about if it doesn't change? So that those fees could be mind-boggling, or it's a lot to absorb for some of the clients.
Yep. And I think as if I was a broker, I would want to know what's going to happen, not just when I place the mortgage,
At the maturity.
at maturity. And that's a big thing, because we know we sometimes are the last resort, or we know we're getting somebody's first decline ever in their life from the bank, the credit union. And they come to us, they've never been declined before. They don't understand why. And it's just maybe tightened guidelines, but they have the equity, they have the discipline, they can make their payments. And then they want to be assured in a year they're not going to have this stress again. And we don't want that. So we're not going to create that stress for them again.
Absolutely. And I even work with a couple of my clients. Where renewal comes up, they really have a lack of knowledge of how to navigate through. And your back office been amazingly hold their hands. It's not like you miss a payment, here you go, we are going to send a letter to exit. They work with them to the point, like I was mentioning to you before this podcast, the client forgot about insurance. They didn't get this insurance on it. VWR went and purchase insurance, and the client didn't have the funds. You guys amortize the insurance premium for 6 months to make it affordable for the client.
Yes.
And those are the things for a lot of audience they don't think the private lender will do. They think the private lender is here to gouge me, take my property away, or kick me out of the house so they can take the property. So a lot of respect for what you guys do.
Yeah, no, that's a great example. And I mean, at the end of the day, if we were to go to foreclosure on a file like that, it would cost us more too. And you're putting somebody out on the street potentially. So
it's a family, right?
For a family. And I mean, I would say we are a family lender, right? So we are, if we look at the condo size, that's the minimum amount. We want the 2-bedroom places. We don't want the 1-bedroom bachelor suite, right? Like it's we're here to help people, help Canadians. And it is sometimes too bad that the private label gets placed on everybody.
That's why we have you to kind of educate the audience and say, hey, it's a solution. So that leads into other questions, Steve. What are your typical borrowers? Investors, homeowners, flippers? Like, what kind of clientele portfolio are you guys mainly dealing with?
Yeah, so we deal with, I mean, we do see a lot of separation, of course. We do see some people having tough time with their debts, repayment, maybe a loss of job at a certain point, a temporary stay in their income. And then they have to get back on track. And so they come to us, clean up credit, move over to the other side. We see a lot of builders and developers as well too, who maybe have that one home left to complete, and they have a couple other properties. We're very good at doing blanket mortgages, inter alia mortgages, and if you own more than one home, a lot of times that's a complicated structure to do at a bank. You're in a holdco, you have all these properties, personal name guarantee. That's no different to us than just doing a regular purchase as well. So that's a big part of it. Our credit score, I mean, believe it or not, our credit score in Ontario, for an example, our average credit score is in the high 600s. We don't take credit score as a determination. We need explanations to it, but it's pretty high. And our average loan to value is actually in the 60s, right? And so we've mitigated our risk across all of our provinces and different cities as well too. But at the end of the day, it's not just all your bottom of the barrel, like this person's going to just default on their first payment type of mortgages, right?
yeah.
So we try to put people back into a situation to keep their home.
Yeah, you also brought up a valid point. A lot of clients are coming for a debt consolidation, and your second mortgage rates are what, at 9.25. If you're having a credit card debt's at 19%, you're pretty much slicing your credit card debt into half
Yes.
of the cost.
Yeah. And then the payment, I mean, you're getting somewhere with the payment.
Somewhere with the payments, yeah.
So we will amortize up to 35 years. If it's a smaller second mortgage, I mean, you can say you want it over 10 years, that's fine. Whatever the affordable payment is, right? Because right now you might be paying interest only or 3%.
You're not going anywhere.
You're not going anywhere, right? So
that's also leads into what's the reason you guys have chosen, like a lot of private mortgages are interest only payment. Why you guys have an amortization?
Yeah. So that's a great question, actually. And I see these ads out there for 50 years, which is interest only as well, too. 35 years, in my opinion, is pretty much, it could be interest only. However, we do want to see some of that paid down so that you're not in the same spot again.
You want them to progress.
You want to make progress. You want to build equity. You want to build wealth. You want to build the ability for flexibility in an emergency situation down the road again. What if something happened again where you lost your job or unexpected medical bills, things like that? We want to make sure that you're paying it down while you can, because we can see that there's cash flow. Let's get this paid down, right? Interest only does have its time and place for sure for something that's very temporary. Let's say you've sold a home and you're buying a new one and there's 6-month gap. Sure, maybe you want to pay interest only. You know exactly what you have. When we have lower loan to values, we will look at interest only as well.
Absolutely. Steve, are you guys provide bridge loans?
Yeah. So we do use both homes as security for sure. So it depends where the first mortgage is at, of course. But yeah, we'll look at that, and we actually don't price those any differently. So
and they're open.
Open term, yep. So
I think this may be valuable for some of the clients. Now that it's hard to sell the property. Sometimes the client would have purchased the property, but they may not able to sell the existing home. So can you kind of walk us through how the bridge works in your situation?
Yeah. So, I mean, if there is the equity there and the ability to make the payments and have, I mean, there can be interest only during that time period, we would just basically place a mortgage on both your properties.
It's a blanket.
A blanket mortgage, right? And then our same rate would apply. So right.
It's open.
1 year open term, and then if you sell within that open, we will pay off the portion that comes from the sale.
Resell the property. So it could be a solution for someone who's kind of in a tight jam. They thought they're going to get the down payment from selling the property, but then now they don't have it. There's an option.
Absolutely. I do encourage people to really have realistic expectations of sale time as well too, because I know best case scenario, everybody believes their home is the best on the street and it's going to sell yesterday. It does take some time. So market data does lead you to believe that's going to take a little longer than normal right now.
Yeah, absolutely. Steve, when you deal with the delinquency, what is the number one reason for a borrower on your space to be delinquent?
Typically, it is either they've incurred more debt, maybe they haven't had advice of how to stop the debt, or they've actually had some sort of job loss, right? That's typically the reasons that we're seeing. Or this might sound a little bit rude, but if there wasn't anything done in the beginning to see where the cash flow was coming from to have the ability to make those payments, it was just place to place. Now, with your brokerage, I know that doesn't happen. You guys always make sure that there is the cash flow there, and it is a requirement as well too. But sometimes because we are direct to broker, not to the borrower,
so you don't understand the full picture of that.
We might not understand the full picture. So it's important, especially when an underwriter has that spidey sense of, hey, there's something else here. There's not adding up. It doesn't appear this person working at Walmart can pay for this $1 million mortgage. What else is happening?
Yeah, right. So the job loss is one of the. So he's not. So most of the time, the clients, as long as they don't want to make the payment, it's not malicious, but they are not. They're put in a situation, job loss, health issues, those other things. It's kind of cost them.
A lot of people get into difficult situations they don't foresee. Right, job loss is the big one right now. Right,
especially with what's going on with the economy.
Yeah.
Can you highlight your rates and the products once again for the audience?
Sure. Yeah. So basically,
it's a simple product sheet.
Yeah. So 1 year terms, open or closed at starting at 695, and then second mortgages starting at, or they're 925 for any loan to value at open or closed. So fees 1% for open terms, and closed starting at $750 for mortgages under $500,000. And then one of the more important things is renewals at $200 for another 1 year term.
Perfect. Steve, thank you for being a great partner. And thank you for always supporting us. And thank you for being here.
Thank you very much. This is great. And thank you for your partnership.
Perfect. Appreciate it. So if you're an audience, you're probably going through financial difficulties, or you are just scared to approach a private lending. Is that the only option that you has been given? You can reach out to our website, Fidus Mortgage Agents at Fidus Mortgages. We will come up with a solution with a great partner, VWR.